You're watching Inside Automotive with Jim Fitzpatrick.
Hey everyone, Jim Fitzpatrick. Thanks so much for joining us today. Our guest today is Pete MacInnis, CEO of eLens Solutions. You've seen him here before on CBT News. With the Federal Reserve recently dropping interest rates by 50 basis points, we thought that Pete would be just the person that we want to hear from and his take on what this means to the industry. So Pete, thanks so much for joining us today. Really appreciate it. I know you and eLens Solutions have got your hand on the pulse of all things finance. You're looking at applications, you're helping dealers move more iron. So what impact do you think that the Fed's move will have on the auto industry? I mean, obviously, a lot of excited dealers out there.
Well, yeah, it's good news for the industry. You know, when you think about it, this was the first rate drop from the Federal Reserve since March of 2020.
Wow.
And that's like over 4 years, and that's like at the beginning of the pandemic, you know. Yeah. And however, that rate drop does not mean that auto loan rates just drop by the same 50 basis points. According to Cox Automotive, the average new loan interest rate so far in September has averaged 9.63%.
Wow.
And the average used auto loan rates has averaged 13.95%.
Wow.
That's higher than in the second quarter of 24.
Wow.
When rates were just 6.84 for new cars and 12.01 for used cars, according to Experian.
So why is that? Why are we seeing an increase in car loan rates like that?
Well, rates are expected to come down, but it's going to take a while. So let's say rates come down another 2 points over the next 18 months. The bigger issue really is the existing debt. You know, when you think about credit card debt at over $1 trillion and student loan debt over $1.7 trillion.
Jesus. That,
along with the prices and goods of services, has consumers stretched with this affordability crisis.
That's right.
So I think we'll see captive finance arms offering more low interest rate subvention programs over the next year, but that will be more about selling cars than traditional lending.
Yeah.
I don't expect traditional banks, credit unions, and finance companies to dramatically move rates downward quickly.
Yeah, and I think it's one of those things that it hits the airwaves, and then everybody feels a lot better about going out and buying, and they start the home buying process and buying cars, and it just seems to like let out some pressure that's been there among consumers. But to your point, don't run into the dealership anytime soon and think, okay, we're going to see lower rates, because it's going to take a while, right?
Yeah, so the Fed doesn't control auto loan rates, right? That's it, the market does.
Right.
The market is what controls that, and there's a lot of factors in that. And when I said that, don't expect banks, credit unions, finance companies to move rates downward rapidly in conjunction with whatever the Fed does over the next year or so, because auto credit is going to remain tight because auto loan performances continue to be weak.
Yeah.
For example, 60-day delinquencies increased to 1.96% in August for the fourth month in a row, and they're up 5.9% over a year ago. Now, in August, 7.41% of subprime loans were severely delinquent, which was up again from 7.23% in July.
Yeah.
So I think what will happen is lenders are going to be reluctant to reduce the spreads they charge. It's so they could compensate for this risk factors that they're seeing moving forward.
Sure.
But over time, the financial performance of consumers improving from lower interest rates on credit cards will ultimately improve auto loan performance, and subsequently the rates will drop more. It's just going to be a slower, longer process because that kind of debt just doesn't go away overnight. People's affordability, they're not going to be able to lower that debt rapidly. And again, you still have all those affordability issues, the inflation issues, and so it's really hard.
Yeah, for sure. And it's confusing to most consumers because they're thinking, well, I'm going to run into the dealership, and if it's not a subvented program, then why are the rates still what they are? And that was a great explanation of that. And because it is set on based on what the market is, and that is a concern of dealers as well as OEMs and finance companies, that we're seeing such an increase in delinquencies. I mean, that's kind of the canary in the coal mine, if you will, right?
Yeah, it's sitting there in the background, and you look at some of those stats, and some of that's pretty scary. I mean, when you think about that much consumer debt on credit cards, that much consumer debt on student loans, hey, those are your prime target buyers there.
Yeah.
And that's going to make it really hard. So when you think about the average price of a car of like approaching $50,000, new car payment over $700 a month, affordability, that's still the top of mind of car buyers. And they're focused more on payment than they are price.
Right.
And that's a big issue. And, dropping rates 50 basis points isn't going to change that dynamic overnight.
No, it's a good
right?
point. Hey, talk to me about, and this may be part of the solution, but talk to me about your new Dealmaker platform. What problems does this solve?
Yeah, so it's specific to that. It's something, we've been talking about it for a long time. It's been coming for a long time. We're going to be launching our beta pilots here coming up in October. And what it's going to do, it's going to put consumers, dealers, and lenders all on the same page, delivering fundable contract terms at the front of the vehicle sales process.
Nice.
It will be real-time interaction.
Yeah, wow.
It's going to be controlled by the dealer. It's going to build trust with customers, and it's going to improve efficiencies for dealers and lenders, which we know translates to better ROI for both of them.
How do you feel about the current economy, and then as we go into 2025, here we are in the last quarter of 2024, do you see some headwinds? Are there concerns that you've got? I mean, you've got your hand on the pulse of what's happening at dealerships and with banks and interest rates and delinquencies and all of that. You think it's going to get better? You think it's going to get worse before it gets better, or where do you stand on that?
I think that both consumers and the government really need to pull back on the wild spending.
Yeah.
That kind of consumer debt. You look at the trillions of dollars that we're going into debt. As a nation. At some point in time, somebody's got to say, we got to just stop this madness.
Yeah.
And otherwise it could create some problems. But if we can get some controls over that, I think it'd be full speed ahead. We just came out of a horrific few years with that pandemic, and the market's been extremely resilient. I think as long as we don't have some major catastrophes, or some world crisis things, we should be all right.
Yeah.
Going into 25.
I mean, there's some positivity out there too in terms of inflation rate coming down to what it is, and interest rates now coming down. Unemployment's still very, very strong at a low number. Stock market still continues to do well. So there's a lot of hopeful signs out there that 2025 would be a good year, regardless of who gets in the White House, right? To some degree.
Yeah, there's a lot of positivity, and we hear a lot of negativity, a lot of noise. But then you go out in the marketplace yourself. Look at car sales are resilient; they're holding up really well.
Yeah.
And all other types of buying, people are saying, "Oh my God, it costs a lot." Yes, groceries are expensive. Yes, gas prices are high nationally. But then what are you doing? You're talking about that with people who are talking about the subjects while they're out for a nice lunch and a nice dinner. They're still spending money.
I know. Here in Atlanta, Bridget and I go out to dinner, and if you don't have a reservation, forget it. You are not having dinner. You might be at the bar having dinner, but every single restaurant, it's amazing. And of course, my adult kids live here too, and they say the same thing about different areas of Atlanta that they live in, and it's just absolutely crazy. It's just that you like you just said, you want to walk out and go, guys, it looks like it's a pretty good economy to me, Crazy.
Yeah, we're pretty fortunate. We live in a great place. It's a great country, and we hope that things will work out well in these elections, and that we'll come out the first of the year feeling positive, and and united, and we can all move forward and continue to thrive and succeed and have good lives.
That's right. That's right. Pete MacInnis, the very positive Pete MacInnis, founder and CEO of eLens Solutions. I know you know that company, and you know Pete from joining us here at CBT News over the years. We very much appreciate it, giving us an update, Pete, and stopping by. I know our viewers get a lot out of it, so thank you so much.
Thank you, Jim.
Thanks.
Thanks for watching Inside Automotive with Jim Fitzpatrick.